Hi, my name is Sandee Rains, and I'm going to talk with you today about credit, your credit scores, and what's actually in your credit report. So let's look at how your credit is impacted by things that are in your credit report, the different kinds of credit types that we could have, what makes up that mathematical model of how the credit bureaus come up with our credit score, your credit report parts, derogatory information, how it gets on there and why, and then establishing credit. You can rebuild or just establish altogether. The need for credit goes for maybe someone wanting to rent an apartment, having your utility services turned on. What about insurance? Did you know that insurance companies pull our credit report, whether it's health insurance, term, life, disability? It could be homeowners insurance, renters insurance. So those things are looked at by your insurance company. Employment, if you fill out an application, there could possibly be a paragraph or an addendum on that application that you sign saying that if you're offered a job, then they would be able to pull your credit report. Automobile purchase, of course. Car, motorcycle, any purchase that might be an installment loan or maybe an unsecured loan. And then homeownership. When you get ready to buy a home, you're definitely going to have your credit bureaus pulled, all three of them, as a matter of fact. There is one official website that you should go to pull up your credit report, and that's www.annualcreditreport.com. This is offered to you 3 credit reports every 12 months, and that doesn't have to be a calendar year. Now, right now, because we've gone through COVID, you are entitled to get 1 free credit report from each of the major credit bureau agencies that you see listed on the slide: Equifax, Experian, and TransUnion. But right now, until December of 2023, you're able to go in and pull up your report if you wanted to on a weekly basis. And once that has exhausted, then it will go back to us being able to pull our own report, 1 free one, every 12 months. And that does not have to be a calendar year. So you want to take advantage of any time that you're able to get your free credit report to make sure the creditors are reporting accurately on you. So we have Equifax, Experian, and TransUnion. We've got the websites, we have the phone numbers listed here for you. So if you ever have a question about something, go to the website, look up if you have to make a dispute, and we'll talk about that a little later. But these are the 3 major credit bureau agencies. Now, I mentioned like Credit Karma, Credit Sesame, Credit.com, and those are okay because they're free to use, but there are ones that you could use like a temperature check just to see what, is being reported. But these 3 here, Equifax and Experian and TransUnion, are your 3 major credit bureau agencies. They go by the FICO score, FICO, and that stands for Fair Isaac Corporation. So what's in your credit report? Well, your identifying information is in your credit report. Your name, social security number, birth date. It could have some of your employers, present and past, listed there as well. And then it's going to have your payment history. Any history that you've had paying on your debt to other creditors, what the balances are, a lot of detail. And then revolving an installment account. So that's where your credit cards show up. That would be your car loans. If you have a car loan and you got it for 5 years, so it's going to show a term of 60 months, right? And then it's going to reflect because there's a 2-year history reported on you to the credit bureau agency. And the ratings. We do not get our credit score right now with our free credit report. Maybe that might happen one of these days. But for right now, you might be able to get your credit score through your credit card companies. If you have any credit cards that allow you to look at your score for free, it doesn't hurt your score by doing that. Some of the credit card companies or even your banks will allow you to pull your credit report and get information that way as well. Public records. Public records would be things like when someone filed bankruptcy, they had judgments, tax liens against them. If someone owes another person child support or alimony, that would be reflected on that person's credit report, showing that they have not paid. So it would be reflected as a public record and how far they're behind in payment to someone else. And then you have inquiries. There are actually two kinds of inquiries. There's a hard hit and there's a soft hit. And your hard hit is when points are deducted every time you make an application with a creditor. Anywhere from 1 to 5 points are deducted from your credit score. So we don't want to go out one day shopping and just apply for credit cards everywhere we go, because it could be 3 points if you went to 3 stores. 1 times 3 is 3. Or if it was 5 points, then 5 times 3 is 15. So it could be anywhere from 3 to 15 points deducted from your score in one day. Now that's quite a number of points to be deducted from your credit score. So you always want to take a look at that, because a lot of inquiries in a short period of time is kind of a red flag to a creditor about what is this person trying to do. They're applying for a lot of credit. So you want to take into consideration only applying for things that you would actually use and maybe that you need. So those inquiries will fall off. Now, when it comes to talking about your score, the higher your score, the less of a risk you are to that creditor, and the lower the rate they would offer you on whatever you're applying for. But then there's the opposite. The lower the score, the more of a risk, and the higher the rate they're going to offer you. You know, when we apply for credit cards, there could be different levels. There could be platinum, gold, silver. And all of that is usually based on the fact that the credit card companies will approve you depending on what your score is. And then if it's a lower score, you're going to get a higher rate than maybe someone that was approved for a platinum card. A lot of the credit card companies, they really want to work with the individuals if they're trying to start out fresh or to build credit, period. So those things are looked at. And if someone doesn't have any credit at all, that's called a ghost file. So many people are trying to rebuild credit after things that have happened in their life that they have no control over. And then there are others that are trying to build credit and start credit. Now, I want you to look at this, because based on what someone's score is and the range where they are. So look at this one. This FICO range is 550 to 599. And then the other one is 700 to 749. So we went from one of the lowest to almost the highest, because a credit score range for FICO is 300 to 850. So we always want the highest, right? So in this particular range, the two ranges here, the APR for the 550 to 599 is an 18% rate that a creditor may offer. But if my score was 700 to 749, they may offer me 3%. I'm less of a risk to them. Monthly payment varies based on your score and what that rate is mostly. So the 550 to 599 would have a monthly payment at 18%, 508. and then 700 to 749 would be a monthly payment of $359 because the rate is 3%. So how much do you actually save? So your monthly savings here showing is $149 versus over the life of the loan, you would save over $8,918. So that's why it's real important for us to always keep on top of what our credit bureau says about us and how that score is reflected to the creditors when they pull my report, because I want to be offered the best rate possible, because that means I'm going to have a lower payment. So let's take a look at the different ranges here of what those particular scores would be. So you have anyone with a score of 800 up, that is an exceptional score. And that person is a very low risk to the creditor. If your score is between 740 and 799, that's a very good score also, and you're considered a low risk to the creditor. If you're between 670 and 739, that's a good score. That's where if people ask, what score should I shoot for? Well, we always want to shoot for the best and the highest, right? But try to start with having 700 and moving forward. If someone has a score of 580 to 669, that's a fair score. Now there's starting to be some maybe questions in the creditor's mind about how much of a risk would this client be if we approve them. And then if your score is 579 or below, that's a poor score. So even if there were guidelines for credit cards or creditors where you could get a loan, you're going to probably pay with the rate, because that's going to be a higher rate because you're going to be a much higher risk to the creditor. So that means your monthly payment is going to be much higher than someone even in the 740 to 799 credit score range. So what actually makes up the components that build up that mathematical model for the credit score? So here's the breakdown. You'll see 5 components here. You've got 35, you've got 30, you've got 15, 10, and 10, right? So 35 is the highest. That's your payment history. It tells the creditor in a snapshot picture, sort of, about how you are paying your bills. Are they in a satisfactory manner? Are you paying on time? Do you have any lates? Do you have past dues at the present time when they pull your credit report? So it's all about how you've paid. Do you have any charge-off, collections, medical debt, evictions, things like that, the bankruptcies? Those all would be reflected in that 35% score range. So what we want to do is pay our bills on time to get the most of that 35%. The next one is 30%, amounts owed. How much do you owe and how much of your available credit have you used? So this is looking at your credit cards. When you have a credit card limit and then you have a balance, so a credit card limit of $1,000 and a credit balance of $500, we call that a 50% credit utilization rate. That means you have used up 50% of your credit limit for that particular card. And the reason this applies to credit cards is because when you do a mortgage loan, when you do a car loan, or any kind of installment loan, as you make your monthly payments, that balance will go down every month, because the first part of the term of your installment loan, most of it goes to interest. So if you have a car loan for 60 months, the first 30 months, most of your payment goes to interest and very little principal. But when you get on payment 31, paying to pay your last payment, then your payment is consisting, a large part of that is principal and a minimum amount of interest. So as you're paying off the debt, you'll see more of the principal payment being paid towards the second half of the term of your loan. Now with credit cards, you can't say that because we use and we pay back on the credit cards. 1 or 2 months, you may not have a balance, so you won't have a payment, right? So the best thing to do is try to keep your credit card balances below 50%. Shoot for 30% or pay them off, but make sure that you're paying them on time. And on time means paying them by the due date. And a lot of credit card companies, when you're paying your credit cards online, there could be a cutoff time. So when you get credit cards, you always want to make sure, don't assume that you have until midnight or you have until 5 o'clock. That is not always the case. So make sure, because if you pay it and they're all due at 5 and you pay it at 6 o'clock, they're going to tag on a late fee. So 30% is how much you owe and how much do you have available on your credit. Now, types of credit, that is 10%. So they look at the number of national bank credit cards that you have, the number of installment debts compared to what that revolving debt ratio is with your credit card balances and limits. And they look at the mixture of credit types. So this is FYI only. I'm not saying you need to go out and have one particular type of credit for everything, but if you have 3 credit cards, that's one type of loan. If you have a car loan, a mortgage loan, and one credit card, that's 3 various types of credit that you've established. The length of credit history is 15%. So they look at the number of months that you've been on file. So the longest, say the credit card, let's say you have a credit card for 10 years. That's a long time for a credit card. So if that's the longest you have in file, then it would be in file for you for 10 years. And it can be longer than that, depending on the individual and what kind of credit. Because we all know that, you know, a mortgage loan is going to be paid off or refinanced, or you're going to sell the house and pay it off, right? And a car loan, you're going to pay off, or you're going to refinance to maybe get a lower rate. But sooner or later, those are paid off or refinanced, and then you start all over with a new loan. With a credit card, your balance goes up and down as you pay and use on it. And that's why it's called revolving debt. And credit cards are compounded interest. So if we carry a balance forward every month, then we're paying interest on top of interest and the balance we're carrying forward. Now, the next one, which is the 5th one, is 10%, and that's new credit. This is based on the number of inquiries someone's had on their credit report within the last 12 months. It's a number of trade lines that was opened in the last 12 months, but it's also the number of inquiries that resulted in establishment of new credit. So those 5 components make up our mathematical credit score, and each of those credit bureau agencies have their model of scoring. If you look at your credit report, you always want to make sure that you see your name spelled correctly, your social security number, your date of birth, your addresses are correct, because that's your identification, and the employment information, all of that is input by someone taking your application information and inputting it into the system to pull your credit report. When someone gets your credit report, it's going to show how you've been paying your debt. The bulk of the credit report is the trade lines, and those particular trade lines would be telling you the date the account was opened, What's the date of last reported information? What was the last date the account was active? How many months has the account been reviewed by the credit bureau? What's your balance, of course? If there's a payment, like for a car payment, it could be $300 a month. That's your fixed payment. If you have credit card debt, like I said before, your balances fluctuate and they go up and down. So one month you may owe a minimum of $15, and then the next month you pay it off, and then you have no minimum payment after that. So really with the credit cards, it just depends on the individual and how they're utilizing it. Then it's going to show a credit limit and then a payment grid. And the payment grid goes back and shows for 24 months of our payment history. C means the account was paid as agreed for that month to be current. X means that no history was reported by that creditor for that month. I know some of my credit card companies that I have, they only report once every 2 months. So there's really, it's up to the creditor on how often they report to the credit bureau. If you see a number, and it's like a payment grid in boxes, right? So if you see a number 30 through 59, that tells you how many times the account was 30 days or more late. If you see a number of 60 to 89, that tells you how many times the account was over 60 days late. And if it's 90 plus showing in the box, that tells you how many times the account was 90 days or more late. It's going to show you the term. So car loan, if it was 60 months, that's a 5-year term. And then with credit cards, it's just going to be revolving because there is no term until you close the card or the creditor can close it also. It's going to give you the status, whether you're current or past due. When it comes to people that have joint accounts, the information is reported the same on both parties' credit bureau. So if I was married, then my husband for a car loan would have the same information reported on that car loan under his name as I would under my name. Now, if you are a co-signer, let's just say a parent co-signs for one of their kids that goes off to college and they assign for a leased car or they purchase a car and they get a loan. The same responsibilities hold true for the co-signer and the primary person. So you want to be very careful if you're co-signing for someone, because if the primary person does not pay, then the creditor is coming and making a call to the co-signer for the payment. So that is part of your credit bureau debt just as much as it is the primary person. Then your credit report is going to show inquiries. There are soft and hard hits. The credit inquiries are towards the back of your credit report when you review it. And the credit inquiries will stay on your report for 2 years, and then they'll automatically fall off. So if you ever see a credit inquiry on your report and it's past 2 years, then you need to go in to dispute that with the credit bureau that the inquiry shows on, which could be all three. And you could go right to the website for Experian, Equifax, or TransUnion and go to the home page for that credit bureau agency and look for the word dispute, start a dispute, or make a dispute, and then follow through and put in the information as they are requesting of you. There are different types of derogative information that someone may have on their credit report. I mentioned a few of them already, but your basic negative information will stay on your credit report for 7 years and 6 months. And then you have foreclosures, short sales, 7 years. You also have bankruptcies, there's a Chapter 7 and a Chapter 13. Now, your Chapter 7 is when you're including everything to and filing with the bankruptcy court of all of the release of your debt, and that stays on your credit report for 10 years. Chapter 13 is when you are in agreement, as long as the creditors are as well, you will pay back to them pennies on the dollar. So that stays on your report for 7 years. If you have a dismissed Chapter 7 or 13, then that will stay on 10 years. Any judgments, and this varies by state, but judgments will stay on for 7, 14, 21 years. So let's say, for instance, Florida. 7 years, someone can file a judgment on someone. Before the end of the 7th year, that person that's filing the judgment has to go back in there to refile. And then they can refile for another 7 years. And then before the end of the 14th year, if they wanted to refile again, they can refile one more time. So the maximum time frame would be 21 years, 3 7-year terms if someone wanted to file a judgment against someone. But you have to check your state where you live to see what the guidelines are. Unpaid tax liens, 15 years, and unpaid student loans, 7 years. Even though things fall off on our credit report, you need to remember that the creditor can still call you and the creditor can still send you letters. You are still legally obligated to pay that debt, but within the time frame then of 7 years and 6 months, it can drop off, or the other ones, depending on if it's a judgment, bankruptcy, that would fall off your credit report at that particular time. Now, if you have to dispute something, then it matters, because if you have something negative on your credit report and you don't take care of it, and maybe it's not true, maybe your creditor is reporting you late. Maybe they're saying you're past due 90 days, and you know that is not a fact. So you want to make a dispute right away, because when you're making a dispute, it goes right to the credit bureau, and then they have to give your information to the creditor so they can check into it. There's a turnaround time of 30 days. So you want to make sure that you do not let errors on your credit report sit there, because negative and blemished information on your credit report brings down your score, and they don't rescore you. So if there are errors on there, it needs to be taken care of. How do you do that? Just as I mentioned earlier, you go to the home page for the credit bureau, Equifax, Experian, or TransUnion. If it's on all 3 of them, you're going to want to dispute with all 3 credit bureaus, and that's one at a time as you go to their home page. Look for the word dispute, make a dispute, start a dispute, click on that link, and it will take you to a page where you put in the information that the credit bureau will need to start your dispute with that creditor. So those are the steps that you need to take, but you don't want to just sit by and let it sit there, because all the while, even though this information is incorrect, that if you don't take care of it, it's going to stay on there. And you want to make sure, if you're wanting to buy a house, you want to buy a car, things that you're wanting to do, your score, as we have gone over, affects the rate and the kind of term of the loan and whether you get approved or not. So it's real important for us to review our reports and stay on top of them. If we're wanting to establish credit, that's the first time, I've ever thought about it. Maybe, someone going off to college and they would like to have a card of their own and their parents want them to have one. you have to be 18, but you want to have a card that you're going to be responsible with. So having a card, establishing credit, it could be even a car loan. Maybe one of your parents co-signed a car loan with you, or you didn't need them and you got a car loan on your own. So you're establishing credit. Their creditors are called trade lines, and those trade lines are going to be on your credit report. So when you want to make sure that you establish banking relationships. Now, your checking and your savings, those kind of accounts are not reflected on your credit report. But credit cards, car loans, mortgage loans, any kind of an installment type loan or credit card is going to be submitted to the credit bureau. And a lot of people have a myth about the credit bureaus, having all of this hold on the information on us as consumers. And that is not true. The creditors report to the credit bureaus, and the credit bureaus take that information that's given to them by the creditor and they put it in a file under our name, our social security number, and then that's where the information goes. Now, if I'm applying for a loan, the same thing applies. The creditor's going to pull up my information, the credit bureau gives it to the creditor, and they decide, looking at my score, what's in my credit report, whether they're going to approve or deny me. And the same thing applies, again, for our department store cards, gas cards, anything like that, it's a credit card. Sometimes people get co-signers. So this is where the family component comes in, possibly, where you could have a mother or father that might co-sign for their son or daughter to get a credit card or to also get a car loan. Now, what that means is both parties are responsible for that debt. So if the parent is the co-signer, then the co-signer is just as responsible for paying that debt and making sure that it's paid. Because if little Jimmy doesn't pay it, then they're going to be calling the co-signer, the parent that signed, and saying, where's our payment? Now, an authorized user, sometimes you'll have parents authorize a child to be on their credit card for their use. You always have to check with the credit card companies to see if they hold the authorized user responsible for that debt, or is it primarily on the primary owner of the credit card. You have several links here that would be good for you to check out as far as getting information about your FICO scores. So you've got myFICO.com. You've got blogs of information. There's all kinds of information about how our credit scores are impacted through these particular links. What I would say to all of you is that you need to make sure when you're looking at your credit reports and your scores, make sure you pull your credit reports on a regular basis. A good idea is to stagger them. Now, right now, until the end of 2023, you're able to pull those credit reports on a weekly basis. But going forward, pull them, your free ones, once every 12 months. And remember, I said that doesn't have to be a calendar year. It's just 12 months from whenever you start. A lot of people like to pull them all at one time if they've never seen them. But then once you get into that habit, a good idea is to stagger them. So I might pull Equifax today, 4 months later pull Experian, and 4 months after that pull TransUnion. And then 4 months after that, I'm going to start all over again. So if there's any blemishes showing up or any incorrect information, you're going to see it sooner than later by staggering when you pull those credit reports. And by the way, when you pull your credit reports, there are 3 options. You could do it online, by phone, or there's a PDF form that you can download when you go to their homepage, each of the credit bureau homepage websites, and you can mail the form in. So, and the phone number is right there for you to call as well. Again, keep your balances under 30% if that is at all possible. The fastest way to improve someone's credit score is to make sure you keep your balances on your credit cards low. Limit these inquiries and beware of automatic repeated inquiries. If you have a lot of inquiries in a very short period of time, remember I said how the creditors will look at what is this person trying to do? Why are they trying to open so many credit cards? You don't want to let your bills go to collections. And again, dispute inaccuracies. If there's anything on there, you need to just jump right on that and start disputing. And if you get overwhelmed and you're not sure what to do, then, call a nonprofit agency, someone that can help you, or do a little research on your own. We are here to help you. At CCCSMD, we would welcome the opportunity to help you have a clear financial picture of what's in your credit report.